Welcome back to Uncomplicated Wealth by Talent Financial Services, where we simplify the complexities of wealth building. I'm Garrett Gunn, and today we're diving into the fascinating topic, decoding the Dow and S&P, understanding the stock market. The realm of stock trading is complex with intricate threads of data, trends, and indices. Among these indices, the Dow Jones Industrial Average and the S&P 500 stand as beacons, guiding investors through the ever-changing tides of the financial markets. In this video, we unravel the mysteries surrounding these influential indexes, exploring their compositions, calculations, and pivotal roles they play in shaping investment decisions worldwide. Tracing its roots back to 1896, the Dow Jones Industrial Average is an institution in the world of finance. Originally comprising of just 12 companies, this index has evolved into 30 companies of the most prominent and influential publicly traded corporations in the United States. The Dow is a price-weighted index, meaning that the impact of each component's stock on the index's value is proportional to its share price. This calculation method differs from market capitalization or market cap weighted indexes, where a company's size and outstanding shares play a more significant role. To calculate the Dow, the sum of the component stock prices is divided by a divisor, which is adjusted periodically to account for stock splits, spin-offs, and other corporate actions that could impact the index's value. Despite its relatively small number of components, the Dow carries immense weight in the financial sphere. Its longevity and the prominence of its constituent companies have solidified its status as a barometer of the overall health of the U.S. economy. Investors, analysts, and policymakers alike closely monitor the Dow Jones movements, using it as a gauge for market sentiment and economic trends. Introduced in 1957, the S&P 500, or the Standard & Poor's 500, offers a more comprehensive representation of U.S. equity markets, encompassing 500 leading companies across various sectors and industries. Unlike the Dow, the S&P 500 is a market cap weighted index, meaning that the larger a company's market value, the greater its influence on the index's performance. This calculation method ensures that the index accurately reflects the overall market's movements, as larger companies tend to have a more significant impact on the broader economy. To determine the S&P 500's value, the market caps of its component stocks are summed and divided by a proprietary divisor, which is adjusted to account for corporate actions such as stock splits, mergers, and acquisitions. One of the key strengths of the S&P 500 lies in its diversification across multiple sectors, including technology, healthcare, financials, consumer discretionary, and industrials. This broad representation allows investors to gain exposure to a wide range of industries, mitigating the risk associated with concentrated investments in specific sectors. While the Dow and S&P 500 were initially created to serve as benchmarks for measuring market performance, they have also become popular investment vehicles in their own right. Exchange-traded funds, or ETFs, and index funds offer investors the opportunity to track and invest these indexes, providing diversification and exposure to the broader market in a single investment. Index ETFs and mutual funds aim to replicate the performance of a specific index by holding the same securities in the same proportions as the index itself. These investment vehicles provide investors with a cost-effective and convenient way to gain exposure to the entire index, rather than having to purchase individual stocks. For more sophisticated investors and traders, index futures and options contractors offer additional ways to speculate on or hedge against the movements in the Dow and the S&P 500. These derivative instruments allow investors to take positions based on their expectations of future index levels, providing opportunities for both risk management and potential profits. Both the Dow and the S&P 500 are highly sensitive to economic events and market conditions, reacting swiftly to factors such as interest rate changes, geopolitical tensions, corporate earnings reports, and shifts in consumer sentiment. Understanding the relationship between these indexes and broader economic trends is crucial for investors seeking to make informed decisions and navigate the ever changing financial landscape. Interest rate decisions by central banks, such as the Federal Reserve in the United States, can significantly impact stock market performance and, consequently, the Dow and S&P at the same time. Higher interest rates tend to increase borrowing costs for companies and consumers, potentially slowing economic growth and weighing on corporate profits. Geopolitical tensions, trade disputes, and global events can introduce volatility into the markets and influence investor sentiment. Periods of heightened uncertainty or conflict often lead to the increased risk and aversion, potentially causing declines in stock prices, by extension, the Dow and S&P. Quarterly earnings reports from individual companies as well as broader economic data releases can have a profound impact on the Dow and the S&P. Positive earnings, surprises, or better than expected economic indicators can drive stock prices higher, while disappointing results or weak economic data can trigger sell-offs and market declines. Within the Dow and the S&P, individual sectors and industries can exhibit varying degrees of performance influenced by factors such as consumer preferences, technological advancements, regulatory changes, and shifts in global demand. The technology sector has been a driving force behind market growth in recent years, with companies at the forefront of innovation and disruption often experiencing significant stock price appreciation. Developments in areas such as artificial intelligence, cloud computing, and renewable energy can significantly impact the performance of tech stocks and, by extension, the broader indexes. The healthcare and biotechnology sectors are also closely watched by investors as advancements in medical treatments, drug development, and healthcare policies can significantly influence the fortunes of companies operating in these fields. Positive clinical trial results, regulatory approvals, or changes in healthcare can trigger rallies or sell offs in healthcare stocks, impacting the overall performance of the indexes. Consumer spending patterns and preferences play a crucial role in performance of consumer discretionary and retail stocks. Factors such as disposable income levels, consumer confidence, changing shopping habits can significantly impact the fortunes of companies in these sectors, which in turn can influence the broader market indexes. As investors seek to capitalize on the potential returns offered by the Dow and S&P, various investment strategies have emerged, each with its own unique approach and considerations. For long-term investors with a relatively high risk tolerance, a buy and hold strategy can be an effective way to participate in the growth of the overall market. This approach involves purchasing and holding index tracking investments, such as ETFs or mutual funds, over an extended period, allowing for the compounding of returns and minimizing the impact of short-term market fluctuations. Dollar cost averaging is a technique that involves investing a fixed amount of money into an index fund or ETF at regular intervals, regardless of the market conditions. This strategy can help mitigate the impact of market volatility by averaging out the purchase price over time, potentially reducing the risk of investing a lump sum at an inappropriate time. More active investors may employ a tactical asset allocation strategy, which involves adjusting portfolio allocations based on market conditions, economic indicators, and investment objectives. This approach can involve shifting investments between different asset classes or indexes in an attempt to capitalize on perceived opportunities or mitigate potential risks. As the financial landscape continues to evolve, the role and methodologies of the Dow and S&P may also undergo changes and adaptations to reflect the ever-shifting realities of the global economy. Over time, the composition of the Dow and S&P may be adjusted to better represent the changing dynamics of the US and global markets. Criteria for inclusion or exclusion may be modified to ensure that these indexes remain relevant and accurately reflect the broader market's performance. Advancements in technology and data analytics are likely to play an increasingly significant role in index construction and analysis. Thank you for joining us on this journey to decode the Dow and S&P. We hope this guide provided you with the valuable insights into these influential indexes and their roles in the stock market. Visit our website for more information, resources, or to schedule an appointment with one of our financial advisors. Until next time, happy investing.